This is Michael King. Today we're going to talk about debt capital markets. In part one, we're going to cover terminology. We're going to look at what is debt, what are capital markets, what is a bond, and what is the yield curve. There are many sources of capital for a company. Debt and equity are the most common, and in between we have hybrid securities like convertible debt and preferred shares that share features of both debt and equity. Debt can be bank debt, it could be short-term money market instruments such as commercial paper, or it could be longer-term bonds issued in markets. What distinguishes these different capital sources are 5 different features: the claim they have on cash flows, their priority in bankruptcy, how their payments are treated for tax purposes, their maturity or life, and how much control they provide the holder over the business. With debt, you're looking at fixed claims that have a higher priority in bankruptcy, where the payments of interest are pre-tax, the bonds are issued with specific maturity, and creditors have limited control over the business only through covenants. With common equity, your claim is to the residual cash flows or profits of the business. You have the lowest priority in terms of bankruptcy. Dividends and other capital gains are paid after tax. The security has a perpetual life, and you are an owner and therefore have control over the business. When it comes to capital markets, you can see that the bond markets are larger than the equity markets. Here we can see that Canada's bond markets are about $3 trillion outstanding as of 2018 versus around a market capitalization of $2 trillion in equity markets. If we look globally, we see that bond markets have a total capitalization of $103 trillion versus $75 trillion for equity markets. We talk about 2 types of capital markets: debt capital markets and equity capital markets. Debt capital markets may also be called fixed income, and as you will see, that includes corporate bonds, government bonds, different forms of asset-backed securities, and other types of fixed income instruments. Year by year, fixed income issuance are much higher than equity issuance. By equity issuance, we mean new sales of stock through an initial public offering. So what is debt? Well, if you look at a balance sheet, on the left we have assets, and on the right we have liabilities and equity, which show how those assets are financed. Debt may be classified as both current or non-current. It is a security that pays interest on a specific time schedule, and those interest payments are required, otherwise the firm will be considered in default and may go into bankruptcy. Debt has a higher claim on the assets in bankruptcy than equity, where equity is both preferred shares and common shares. So debt is money borrowed by one party, known as the borrower, from another party, known as the lender or the creditor. It is a contract, and that contract is specified in a document called the indenture. Debt is less risky than equity because of its higher claim on the assets. It also does not have the upside of common shares because the only claim that debt holders have is interest payments and the repayment of principal. For this reason, debt holders or creditors are not considered owners of the business. They don't have any votes, and they only exert indirect control. Accountants will classify debt based on its maturity between current and non-current, where current is less than 1 year. But as financial analysts, we tend to think of money market as being less than 1 year. We look at notes as being from 1 to 10 years, and bonds typically longer than 10 years, up to 30 years or longer. There are 2 categories of debt. There is debt that is not traded, typically bank debt, and there's traded debt, which is marketable. Bank debt are loans issued by banks that can be short and long term, anything from 30 days out to 5 to 7 years. It may be secured or unsecured against collateral. Typically it pays a floating rate of interest that changes each quarter. The debt is not rated, and it's not generally traded. Examples of this type of debt would be lines of credit or revolvers and term loans. Marketable debt, shown on the right, is sold to investors either privately or publicly. Debt that is sold privately is known as a private placement, whereas debt that's sold publicly is issued in public capital markets. It may be short-term or long-term. It may be secured or unsecured, and it typically pays a fixed interest rate. Unlike bank debt, most publicly sold debt has a credit rating from either Moody's, S&P, or Fitch rating services, and these securities are traded in what is called the over-the-counter market. There's very little trading on exchanges. It's usually done from one counterparty to another. It used to be over the phone, but now it's done electronically using computers. Money market securities would include commercial paper or bankers' acceptances and bills, and longer-term securities would be notes, bonds, which is sometimes called debentures. So what is a bond? We're going to define bonds using this terminology. A bond has a coupon, which is the rate of interest that it promises to pay over the life of the security, and that coupon could be either fixed or floating. There is a frequency at which coupon payments are made. Typically, corporate bonds will pay a semi-annual coupon, meaning every 6 months, whereas in Europe and in Japan, bonds may pay interest annually. There are also securities that have a floating rate of interest, known as floating rate notes, that will pay quarterly. The maturity is the date on which the bond has to be repaid, where the borrower has to repay the principal amount to the holder of the bond. The bond will have a face amount or a par value, which is the amount of a single bond. For a North American bond, it's typically $1,000. The price of that bond is usually quoted as a percent of par. So a bond would be quoted as 100, meaning it is trading at 100% of its par amount or face value. The price is obviously the present value at which the bond is trading. Sometimes you hear the term principal amount or issue size. This refers to all the bonds sold at one time by a company. So if a bond sells $750 million at one time, the principal amount is $750 million, but the bonds themselves are made up of $1,000 increments. Typically, bonds will trade in a minimum size of around $1 million, although with electronic trading, it is possible to trade less. Unlike the coupon, which is fixed, the bond's yield to maturity is the expected return that you will earn if you hold the bond through to maturity, receiving both interest payments as well as the final principal payment. You can think of it as the internal rate of return based on the price that you pay today until the bond repays at maturity. Bonds are known as fixed income instruments because they have a structure of interest payments that are set in the indenture and are well known at the time the bond is issued. They also repay their principal or face value at maturity. Remember, bonds have no votes. They only have indirect control, and they have a higher claim in the event of bankruptcy than equity. So they have a lower risk and a lower return. Let's take a look at a treasury bond. This is an actual bearer note issued back in 1979. In the top half, you can see that it was issued by the United States government. It has a face value of $1,000 and is paying an interest rate of 9%, where the interest rate is paid semi-annually on February 15th of each year and August 15th of each year. The bond will mature on February 15th, 1987. The interest is payable twice a year on the 6-month anniversary date. The bottom half of this bearer bond shows the coupons. And notice that the coupons are individual payments of $45. That represents 9% divided by 2 every 6 months times $1,000 for $45. It used to be that you would cut those coupons off and mail them back to the trustee in order to receive payment. That was why they were called coupons. Notice that the interest rate on the bond is only used to determine the dollar value of the coupon. So when we come to valuing bonds, forget about the interest rate and think about the coupon as a dollar value that you will be receiving with some fixed payment schedule. Bonds can be either secured or unsecured, where secured bonds are backed by specific assets or collateral. It could be buildings, it could be machinery, it could be airplanes, train cars, or it could be a building, in which case it would be considered a mortgage. Secured bonds have a higher claim in the event of bankruptcy to those assets than unsecured creditors. Unsecured bonds are typically what is issued in bond markets. They're backed only by the company's ability and willingness to repay. They rank behind secured bondholders in the event of bankruptcy, but ahead of all equity holders. Bonds have different types. The most common is a bullet bond or a plain vanilla bond that repays its full par amount at maturity. However, bonds may have different embedded options or features that allow the borrower to repay some or all of the bonds prior to maturity. For example, a sinking fund bond would have a set schedule of periodic repayments that will allow the bond to be paid off or amortized over its life. A callable bond allows the issuer of the bond to call it back and repay it early using a preset price. A puttable bond allows the investor to put the bond back to the issuer at a preset price. Now, we often refer to bonds issued by governments as risk-free when they issue in their home currency. That's because they have the ability to raise taxes in order to pay for the bond or to print money. Not all government bonds are risk-free, however, when they're issued in foreign currency, as we can see looking at debts, for example, issued in the euro by the sovereign Greece. Bonds issued by corporations and other entities typically have a higher risk of default, which is called credit risk. In Canada, we have bonds issued by the federal government, by the provinces. Below them, we have government-sponsored entities. You may have utilities, such as Ontario Hydro or Hydro-Quebec. Below them, you would have corporates. And finally, you would have financials. These are the different categories of issuers. The yield curve, or the term structure of interest rates, refers to a graph that is drawn by connecting the yields on bonds of different maturity issued by the sovereign or the government. Here we can see, for example, the Government of Canada's bonds that are issued with maturities from 3 months out to 30 years. The most recently issued bonds are called on the run, and older issues are called off the run, and these bonds are sold in auctions with specific dates. Notice that bills have a maturity of 1 year or less when they're issued. They do not have coupons, and they're sold at a discount to par, so they effectively have no coupons and are called zero coupon instruments or discount instruments. If you were to graph the yield on the different securities against the maturity, you get what is called the yield curve. This is simply a line connecting the dots for different maturities. If we were to look at the US yield curve over the past 2 months, we would see that the US yield curve has declined. Notice that on March 2nd, the green line, an unusual shape, short rates of 1 month were offering a similar yield to bonds with 10 years and longer. Because of the COVID-19 pandemic, interest rates were slashed by the US Central Bank, the Federal Reserve, at the short end by 150 basis points. As a result, short-term yields on US government securities came down quite dramatically. Now we have an upward sloping yield curve. The yield on a 1-month security of 0.10% or 10 basis points is quite a bit lower than the yield on a 30-year security of 1.4% or 140 basis points. 100 basis points is equal to 1%. There are different theories for what explains the shape of the yield curve. The most typical theory is that the yield curve is upward sloping because of the risk and return trade-off for holding a bond for a longer maturity. However, there are theories that suggest that different investors have preferred habitats and purchase bonds in different maturities. You can read more about different theories of the yield curve in the readings from our ebook.